Guys, I've already made numerous videos explaining why I believe that real world assets is going to bring in the most money in this upcoming 2024 crypto bull market. In this video, we're going to be talking about a derivative within that same real world asset narrative and why I think it's a fantastic investment opportunity, as it's kind of just like a blue ocean if you read the book Blue Ocean Strategy. That sector, that derivative narrative is private borrowing and lending protocols. So guys, in this video, we're going to briefly cover the history of borrowing and lending, the problem in the industry, how Web3 protocols are looking to solve these issues, why we expect this sector to pump really hard. And at the end, if you stick around, I'm going to give you guys some protocols that we're looking at that we expect to pump going into the 2024 bull market. So before we get started, I do have to say this video should not be taken as financial advice. Please consult with your financial advisor before making any investment decisions. This video is for your education purposes only. All right, so let's jump straight into the content, starting off with a little bit of history. So this is probably obvious, but borrowing and lending is one of the oldest practices in human history, as it goes back to the ancient Mesopotamia days. Believe it or not, ancient lending actually started in the form of pawnbrokers, kind of like how pawn shops allow you to pawn something. This is simply just a loan that's collateralized by an object that has value. So early forms of credit actually emerged as owners lent production materials to labor workers and they expected a repayment of goods. And the crazy thing is, if the borrower failed to pay, they actually risked their family being taken as slaves. So you go to a pawn shop, let's say I want to pawn this phone. They say, oh, that phone's worth $1,000. So now you can borrow, $1,000 or whatever the case is. If you don't pay it back, they sell your phone. And I'm sure they mark up a little fee. I've never pawned anything. They mark up a fee so they can make some money for kind of like a convenience fee. They don't want to just break even. Now, credit is still just as important, if not more important, for individuals, businesses, and entire nations, because it allows them to access capital without diluting ownership, like via equity. And this leads to economic growth. To show proof of this, if you look at any third world country, a big reason, amongst other things, why they're a third world country, and the mystery of capital talks about this in depth, a big reason why they're in poverty is because their property system is behind. Like, they can't prove who owns what when. And if you can't prove who owns what, then you can't extract credit from it. You can't borrow against it. If you can't prove you own something, you can't borrow against it. That's why you have all of these people owning their assets, owning their homes, their businesses illegally. Right? And if you own something illegally, no bank is going to use it as collateral and give you a loan for it. And the only reason why we here in the US have this good property rights system is because of the 49ers. When people came over here to mine gold, people were laying claims via paper and fences saying who owned what when. And over a century, the government consolidated all of those. And now we have the property rights system that we know and love today. And that's how we're able to get access to credit and borrow money, because not only are we the world reserve currency, but it's easy to prove that we own our home, for how long, the history of the home, etc., etc. So in TradFi, credit can generally be broken down into two types. You have secured credit and unsecured credit. A mortgage is a type of secured credit, as the loan is collateralized by the property. And if you look at a credit card, this is a type of unsecured credit, as one can regard it as being collateralized by the credit worthiness of the borrower. So for example, in a typical mortgage, a buyer puts down a 10 to 50% down payment for the market value of the property, and then they finance the rest from banks. The difference between the property value and the down payment is credited by the banks. Here's the problem in DeFi, on the contrary. The majority, if not all, of the lending protocols are based on over-collateralized lending, similar to the pawn shop's lending style. And this does not involve creating credit. An equivalent to an over-collateralized mortgage in DeFi would be like if Jeff Bezos had to put down $1 billion of Amazon shares to borrow 500 million. It's not going to be attractive to him because he already has $1 billion and he can easily find a bank that's willing to lend him $10 billion. Now, we're going to come back to that mortgage example here in a bit. So we talked about this earlier too. You have two forms of financing that's available for traditional businesses. You have debt financing and equity financing. Equity financing revolves diluting ownership. You give up a percentage of your company in exchange for money and a little bit of control. Founders typically avoid this, especially in the early stages, because they don't want to dilute themselves too much to maintain control, and they would like to get some sales and some revenue so they can raise money at a higher valuation later down the line. And equity financing doesn't create credit because the business sells part of itself in exchange for cash. So to maintain majority control, businesses prefer debt financing because you can pay it back in the future. So now let's talk about what's preventing credit creation in DeFi. All right, so like I mentioned earlier, DeFi borrowing and lending still follows that pawn shop model where borrowers put down something of value as collateral and then they take out cash less than or equal to the collateral's value. Now, going back to the mortgage example, can you imagine how impractical it would be if, let's say I want to get a mortgage for $300K, but in order to get it, I have to put down collateral of $350 to $450K. The whole point of borrowing money is to get access to funds that I didn't have access to beforehand, right? So over collateralized lending is good, but it's not how people in the real world borrow money, and it's for damn sure not how institutions in TradFi borrow money. Now let's talk about why DeFi does this over collateralized lending. It's ultimately because DeFi lending and borrowing protocols are permissionless, and it has its upsides and it has its downsides. Let's go through some of them here. The upside is it offers a few different trading and hedging strategies. You know, I've made many videos talking about how you can go on Aave or Radiant Capital and get paid passive income to enter into a leverage position. It's safer. Let's say I want to bet on Ethereum going down. I can use my USDC as collateral and I can borrow Ethereum. I can sell that Ethereum for USDC, supply it as collateral again, borrow more Ethereum, sell it. And if the price of ETH goes down 50%, I can take my cash and buy Ethereum cheaper. I pay back my loan and I keep the difference. You can do the same thing on the upside. So it offers different hedging strategies, a safer way to access leverage. And if you play it right, you can get paid to do it on different yield farming protocols, such as Radiant Capital. Another cool thing is that it's basically resistant to prejudice against any borrowers because the protocol doesn't know or need to know your identity. And the reason why is because all they need is the collateral. If you deposit on the platform more than what you're borrowing and you don't pay it back, they just keep your collateral and a fee. They let you keep what you borrow. However, let's talk about the downsides. This affects the pre-lending credit check KYC procedures that usually precede credit origination in the TradFi world. So since mainstream DeFi lending protocols don't know the true identity of the borrower and assess the credit risk, they're left with over-collateralization as a way to make sure that lenders are always made whole and are always protected. Under-collateralized lending is also less risky for the borrower because when you are borrowing via over-collateralization, you have to trust that that platform isn't going to get hacked and you're not going to lose your collateral, because remember, the value of a collateral is worth more than what you borrow, assuming you didn't make a successful trade or something like that. So to wrap this idea up, essentially the core DeFi principle of being permissionless prevents DeFi lending markets from growing because there are better lending options where you can borrow money in an under-collateralized way in TradFi. Now, if we go to DeFi Llama and we click the lending TVL category, remember this is like over-collateralized lending protocols, you can see that the current TVL is 27.39 billion. That's a drop in the bucket when you look at all the money that's in the world and the demand for people to borrow money. At the peak, we were at 50 billion, but you know, when Celsius and FTX and that whole thing happened, we saw a drop off, but we're starting to see an uptick as we're going into the bull market. However, if we look at the St. Louis Fed website, you can see that the total size of the credit markets, and this includes all sectors, debt securities and loans, liability level, this is pretty much everything. I know it's worded weird, but right now it's $96.8 trillion. And this is mainly because of the capital inefficiency when it comes to assessing price and credit risk. So having that said, the introduction of under-collateralized lending protocols to the DeFi space has understandably sparked heavy interest from institutional borrowers and lenders, especially during a period when liquidity in the global financial system is being drawn out by the central bank due to high interest rates. You know, the Federal Reserve has a goal to keep interest rates at 2%. And historically speaking, in order for them to get it there, they have to have rates pretty high for a while. They have to get inflation under 2%. So that means people who want to borrow money in the real world, not only that, you know, it's kind of like it's monopolized. So the few institutions that are loaning most of the money, they set the prices. So you have high interest rates. Not only that, these banks have a higher customer acquisition cost because they have to keep up with their brick and mortar, their ATMs. So they can't lower the rates past a certain point. So all these things make capital more expensive to borrow in the TradFi world. It's also worth noting that the defaults from large centralized finance lenders like Celsius and the like, and the bad acting by BlockFi, Galaxy, Three Arrows Capital, FTX have led to an overall credit contraction in the crypto sector. as CeFi lenders' risk appetites have dramatically reduced. Now, here's where the opportunity is. This leaves crypto companies with way fewer options to undercollateralize borrowing. To prove it to you, you visit RWA.xyz and you can see these are active loans by undercollateralized protocols. You can see at the peak, they had $1.5 billion in loans. It dropped off with the whole Celsius things like we just talked about, but you can see it's been actively rising, 400 million, 500 million. So now we're at around $508 billion, not million, billion dollars. And this trend will continue. Also, if we go on Token Terminal and we hit borrowing and lending and you see the increase in TVL for the weekly gainers, you can see that maplefinance, we made 2 in-depth videos on maplefinance. One covering literally everything you need to know, the tokenomics, the fundamentals. We went through the docs, the smart contract audit, literally everything. And then I made one on how I plan on turning $15,000 into $1 million. And I showed my exact take profit and yield farming strategy. You can see that the TVL increased 418%. Those are not small numbers. I mean, look at the other protocols that it's compared to. And this is why maplefinance is one of our largest portfolio allocations in the private credit sector. Now, let's keep moving on. There are two types of customers, ideal customers, that these private credit protocols like to look at. And those are crypto native companies and businesses in emerging markets. And the reason why is because banks don't like lending to emergent markets businesses because they see them as more risky. The crypto companies that's currently taking out loans on these protocols are mainly hedge funds and trading firms. And even though these companies have similar, if not better performance and healthy balance sheets compared to TradFi companies, they're still unable to obtain loans through traditional banks and financial institutions. So that means it's a huge opportunity for protocols like Maple and the like to come in and provide value and provide funding. Now let's kind of talk about their business model. So you're probably wondering like, well, if they're not doing over collateralization, like how are they protecting themselves against default? Like how are they making sure that they're getting paid back? So most DeFi credit protocols currently do not originate the loans, but rather they act as a middleman by connecting borrowers and lenders. The main source of revenue for these credit protocols is similar to like a Aave or a Compound, which is a share of interest revenue from outstanding loans. Once the onboarded institutions start originating loans, these credit protocols typically either take a percentage of the interest revenue generated from these loans, or they charge a small fee at the point of loan origination. And when it comes to defaults, these protocols are responsible for providing the appropriate risk assessment, KYC, AML, and credit checks required before loan origination. And they're also responsible for deciding the interest rates based on that risk level. The cool thing is this typically happens off chain. So they'll sign all the paperwork, they'll agree to the interest rate, and then the funds are actually loaned on chain. And it's important to note that you can build CeFi protocols on top of decentralized protocols, as Maple is built on Ethereum, but you cannot build decentralized protocols on top of centralized technology. All right, so now let's talk about how the actual borrowing and the lending works. Now, the lending is typically permissionless. You can go on there. There are some permission pools, but for the most part, they're permissionless. You go on there, you provide your liquidity. They tell you the yield that you get. They give you all of the data. A lot of times you can export it via CSV file, but if you want to borrow money, that's when you have to go through the KYC, the AML, the credit checks, and all of that stuff. And that's how it has to be. They have to know your identity to give you money without any collateral. Now, having that said, how is DeFi better? Because I know it probably seems like under-collateralized credit issuing protocols are really just on-chain copycats of traditional banks for lending institutions, especially when you factor in their centralized nature. Compared to Compound or Aave, they're over-collateralized counterparts. However, DeFi credit protocols offer advantages throughout the entire process and lifetime of a loan that's actually not replicable in TradFi. So in TradFi, the amount of credit that one can receive depends on a framework commonly referred to as the 5 C's of credit. You have character, capacity, capital, collateral, and conditions. They have to go through all these things, and it's not as straightforward as just approving a transaction within your MetaMask wallet. It's bureaucratic, which makes it very, very time consuming, but it also makes it expensive because given that it's bureaucratic, it's more involvement required from multiple parties, and those multiple parties have to get paid. And guess what? That money comes out of your loan. So you're actually not able to borrow as much. It takes a long time. It's harder to get approved. Like it's a shit show, to be honest. Whereas when it comes to these DeFi protocols, they make it extremely, extremely easy. If you get approved once, you don't have to go and reapply. Like, they really not only make it quicker, but given that it's operated from smart contracts, it's less middlemen involved, so it's also cheaper. So now we've gotten to the end of the video. Why am I expecting this sector to pump in the bull market? It's actually quite logical. So in the bull market, these crypto companies who are looking to borrow money, a lot of them will have Bitcoin and other altcoins on their balance sheets. Once their balance sheets balloon because prices are going up, it's going to make their risk appetites go up because everyone's going to feel like a genius. But more importantly and more practically, it's going to make them more credit worthy. So it's going to be easier for them to borrow money. And since they can't borrow money through the traditional means, they're going to have to come and borrow money from private credit protocols like we're covering in this video. And that's just going to make the fundamentals of these private credit protocols increase, which will lead to a price pump. So if we go back to RWA.xyz, it gives you the KPIs across the top private lending protocols in the RWA sector. You can see number one is Centrifuge, and they're number one in terms of active loans. They have 272 million. Maple is number two, but they've done more in total loans. They've done over $1 billion, right? It gives you the average APY, the cash drag, and the cash drag is the percentage of idle capital in the protocol. So that means Maple is using up 100% all of the lender's liquidity, which is really, really good, right? They give you the market cap. So Maple has a market cap of 95 million, but right now on active loans, they have 162 million out. So they're just fundamentally right now, they're undervalued because their active loan to market cap ratio is very favorable. So we're going to be looking at all of these protocols, and I'm going to be releasing videos. I've already made videos on my favorite ones that'll be releasing this week, next week. If you want to get access to those protocols, some of which have already pumped, one of them our members are up 80%. Click the link in the description, book a free strategy session. We'll see if our program is a good fit for you. You get access to our buy calls, my YouTube videos before they hit the internet, certain YouTube videos that are, worth getting access to early, as well as our yield farming course where we show you how to accumulate these assets passively so you have more to sell when the next bull market comes this year. But if you don't want to do that, you can always go on this website and just go through and research all of these protocols. All of them will probably pump, but we're trying to find the best ones and the most undervalued ones because a great company at a bad price is not as good as an okay company at a great price sometimes. Let's talk about another reason why we think this sector is going to pump. You go to CoinGecko, you type in RWA, you hit categories, not cryptocurrencies. Now, what you want to do when you're going into a bull market is find projects that have not had their time in the sun yet. Because projects who pumped the last bull market normally don't pump as much in the next one. It's the law of diminishing returns. And if we believe the real world sector is going to bring in the most money, I am 99% sure that some of these protocols are going to be within the top 100, top 50, top 20, maybe even top 10. None of them are even in the top 100 yet. Some of them are. I called out Pendle back in November. It's up over 300%. If you watched the video and did your research, you could have made some money. You can see Maple is on here, $95 million. Goldfinch, Clearpool, TrueFi, all of these were on the RWA.xyz website. Now let's kind of compare them to borrowing and lending protocols, over collateralized borrowing and lending protocols, and how they pumped in the last bull market so that we can make our case even further. So in the last bull market, we saw Aave reach a $7.9 billion market cap. Do you realize if Maple reaches that, that's almost 100x? My ballpark math is off right now, but you have to keep in mind, Aave is a protocol where retail investors go on to borrow and lend money. These private credit protocols are focused on institutions. So I believe the TVL and the volume and all the metrics are going to be way higher because they have most of the money. So it's not out of the question if I think Maple Finance could reach a $10 billion market cap in a bull market where we have a Bitcoin ETF approved, we got the halving, and we finally have institutions getting in, and crypto is just more and more legit. Let's keep going. In the last bull market, we saw Compound reach a $4.3 billion market cap. Even if Maple Finance was just to reach this market cap, that's still a significant multiple for current prices. But like I said, this was mainly used from retail borrowers and lenders, not institutions. Let's look at one more. If we look at MakerDAO, which is a lot of times the leader when it comes to borrowing and lending protocols, I think is number one right now. It reached a $5.5 billion market cap. Same thing, mostly used by retail investors. They have their DAI stablecoin. What is there to say if you have private credit in a blue ocean, right? You have so much demand, Balance sheets are going to be ballooning. Institutions are going to be looking to borrow. If Maple reaches a $4.8 billion market cap, that is still over a 50x, guys. Super conservatively, right? Like, guys, there's going to be opportunities for 50, 100, 200x's pretty conservatively, guys. It's still pretty early, and a lot of people don't have their eyes on this market because it's not super sexy. So guys, with that, I like to conclude this video. I hope you got value from it. If you did, drop a comment, drop a like, share it with a friend. Let me know what real world asset or private credit under collateralized lending protocol you want me to cover next. And like I said, if you're interested in this and you want to be able to conduct this research on your own and learn how to yield farm and just be a part of an elite group who's passionate about crypto and investing, click the link in the description and book a free strategy session, and we'll see if our program's a good fit for you. We only let a certain amount of people and a certain type of person in. But with that, I conclude this video. I thank you guys so much for watching. I love every single one of you, and I'll see you guys in the next video. Take care and trade safe. Hooah!